In today's lecture, we are going to study acquisition valuation, control premiums, payment method, and deal financing. This is an important topic because an acquisition is not just the purchase of assets, earnings, customers, or market share. It is the purchase of control. The buyer is acquiring the right to influence future cash flows and the opportunity to change how those cash flows are created. The central question is simple but powerful. How much can the buyer pay and still create value for its own shareholders? That question connects acquisition analysis directly to capital budgeting. A proposed acquisition should be treated like a large investment project. The buyer gives up cash, shares, borrowing capacity, or financial flexibility today and expects future benefits in return. But here's the key idea. Buying a good company is not the same as making a good acquisition. A wonderful target can become a poor deal if the price is too high. So, throughout this lecture, keep your attention on value creation. We will separate the target's standalone value, the value of synergies, the costs of integration, the premium paid to the seller, and the financing effects that shape the final outcome. Let's begin with acquisition valuation as a capital budgeting decision. When a buyer evaluates a target, the first step is to ask what the target is worth on its own. This is the standalone value. It reflects the target's current strategy, operations, assets, risks, and expected cash flows before considering what the buyer might change after the deal. The second step is to estimate synergy value. Synergies are the incremental benefits that exist only because the buyer and target are combined. These may come from cost savings, revenue improvements, working capital efficiencies, tax benefits, financing benefits, or better use of assets. The third step is to account for the costs required to make those synergies real. Integration costs matter. A synergy that sounds attractive in a presentation may require restructuring, system changes, employee transition, customer retention efforts, and management attention. The fourth step is to include transaction costs such as advisory, legal, financing, and other deal-related expenses. The acquisition rule shown in the background reminds us of a simple principle. The buyer creates value only when the incremental benefits exceed the premium, integration costs, transaction costs, and risks assumed. This is why disciplined buyers establish a walkaway price before the emotion of negotiation takes over. Now let's talk about standalone target valuation. Standalone valuation asks what the target is worth before buyer-specific synergies. The buyer should not begin by saying, "What could this company be worth if everything goes perfectly?" Instead, the buyer should ask, "What is this business worth under its own current plan?" There are several common valuation approaches. Discounted cash flow analysis values the target based on expected future free cash flows, risk, and terminal value. Its strength is that it forces the analyst to think about the business directly. Its weakness is that it can be highly sensitive to assumptions about growth, margins, reinvestment, discount rates, and terminal value. Comparable company multiples compare the target with publicly traded firms that have similar business characteristics. This gives an external market reference point, but public trading multiples often reflect minority ownership values, not full control value. Comparable transaction multiples look at prices paid in prior acquisitions. These can be useful, but they may already include control premiums, expected synergies, auction pressure, or unusual market conditions. Asset-based valuation focuses on the value of assets, less liabilities. It can be useful in some settings, but it may miss value created by intangible assets, organizational capabilities, customer relationships, or growth opportunities. A strong analysis uses multiple methods, then investigates why they agree or disagree. Let's go deeper into discounted cash flow valuation and market multiples. In a discounted cash flow valuation, the target is valued based on expected free cash flows and a terminal value, discounted for risk. The most important point is that the discount rate should match the risk of the cash flows being valued. The buyer's current cost of capital is not automatically the correct rate for the target. If the target operates in a different industry, country, business model, leverage range, or risk environment, the appropriate rate may be different. A good DCF model makes assumptions transparent. Managers should be able to explain where growth comes from, how margins are expected to change, what reinvestment is required, how working capital behaves, how taxes are modeled, and why the terminal value is reasonable. Market multiples provide a useful reality check. They show how investors value similar companies, or how acquirers have priced similar transactions. But a multiple is not a substitute for judgment. If the target deserves a higher multiple than peers, the buyer must explain why. Is it faster growth, better margins, lower risk, stronger customer retention, better intellectual property? And after estimating enterprise value, the analyst must adjust to equity value by considering debt, cash, and other non-equity claims. Next, we need to value synergies separately. This is one of the most important disciplines in acquisition valuation. The target's standalone value belongs conceptually to the target's current owners. Synergy value is created by the combination. If the buyer pays away all expected synergy value through the premium, very little remains for the buyer's shareholders. Synergies should be operationally grounded. A cost synergy should identify what will actually change. Will facilities be consolidated? Will duplicate systems be removed? Will procurement improve? Will overlapping functions be reduced? Revenue synergies need even more caution. They often sound exciting, but they depend on customers, sales execution, competitive response, pricing behavior, and timing. A statement like, "We will cross-sell more," is not enough. The buyer must identify who will buy, through which channel, why they will buy, and when the cash flows will arrive. Working capital synergies may come from inventory management, collections, supplier terms, or cash pooling. Some benefits may occur only once, rather than continue forever. Tax and financing synergies may arise from tax attributes, borrowing capacity, or more efficient capital allocation. But these benefits can be limited by regulations, tax rules, credit conditions, and added financial risk. The main lesson is clear. Synergy is not a slogan. It must become cash flow after risk and after implementation cost. Now let's move to reservation prices, bargaining range, and control premiums. A transaction can occur only when the buyer is willing to pay enough for the seller to accept, but not so much that the buyer destroys value. This creates a bargaining range. The seller's reservation price is the minimum acceptable value for target shareholders. It may depend on the target's standalone value, current market price, alternative bidders, management's confidence in the standalone plan, and the form of consideration offered. The buyer's reservation price is the maximum price the buyer can pay without destroying value. The buyer's ceiling depends on standalone value, credible synergy value, integration costs, transaction costs, and risk. If the seller requires more than the buyer can justify, the buyer should walk away unless the economics of the transaction can be improved. A control premium is the amount paid above unaffected value to obtain control. It may be justified if control allows the buyer to change strategy, improve operations, replace management, sell assets, alter capital structure, reduce costs, or combine the target with the buyer's assets. But the premium itself does not create value. It transfers value to the seller. The key question is, what does control allow us to do that the target could not do on its own? Overpayment is one of the greatest dangers in acquisitions. A buyer can identify a strategically attractive target and still pay too much. This is why acquisition discipline matters so much. One common source of overpayment is overestimated synergy. Managers may assume that cost savings or revenue growth will be larger, faster, or less risky than execution realistically allows. Another source is underestimated integration cost. Severance, system migration, culture clashes, customer losses, regulatory commitments, and management distraction can reduce the value of the deal. Competitive bidding pressure is also dangerous. In an auction, each higher bid transfers more expected value to the seller. The winner is not always the smartest bidder. Sometimes the winner is the bidder with the most optimistic assumptions. Managerial hubris can also play a role. Executives may believe they can improve the target more than evidence supports. Empire-building incentives may push managers toward larger organizations, even when size does not increase shareholder value. Poor due diligence can create surprises after closing. Accounting quality, customer concentration, legal liabilities, operational weaknesses, technology limitations, and hidden obligations must be examined carefully. Finally, beware of shortcuts. Accretion, revenue growth, market share, or transaction multiples are not substitutes for value analysis. A disciplined acquisition team asks, what assumptions must be true for this deal to create value? And are those assumptions credible? After deciding what the target is worth, the buyer must decide how to pay. The main forms of consideration are cash, stock, or a mix of both. Payment method affects risk sharing, ownership, leverage, liquidity, taxes, signaling, and post-deal flexibility. A cash offer gives target shareholders certainty. They receive a fixed value and usually do not participate in the upside or downside of the combined firm. For the acquirer, cash means existing shareholders keep all synergy risk and reward. But cash can reduce liquidity, and if funded with debt, it can increase financial risk. A stock offer shares risk. Target shareholders become owners of the combined company. If the combined firm performs well, they benefit. If synergies disappoint, they share part of the downside. Stock can preserve cash and limit leverage, but it dilutes existing acquirer shareholders. Mixed consideration balances certainty, participation, leverage, dilution, and risk sharing. In stock deals, structure matters. A fixed exchange ratio deal gives target shareholders a specified number of acquirer shares, so the value they receive moves with the acquirer's share price before closing. A fixed-price stock deal promises a set value, so the number of shares issued adjusts with the acquirer's share price. This protects target value, but can increase dilution for existing acquirer shareholders. Callers can limit these movements and help allocate risk between the parties. Now, let's discuss deal financing. Payment method describes what target shareholders receive. Financing describes how the buyer funds the payment and supports the combined firm after closing. A cash offer may be financed with cash on hand, new debt, asset sales, equity issuance, hybrid securities, or some combination. Even in a stock deal, the buyer may still need cash or debt to refinance target obligations, pay transaction costs, or fund integration. Cash on hand is simple and fast, but it reduces liquidity and may weaken financial flexibility. New debt avoids ownership dilution and may create tax benefits, but it increases leverage, interest obligations, refinancing risk, and possible credit rating pressure. Equity issuance preserves cash and borrowing capacity, but it dilutes existing shareholders and may be costly if the buyer's shares are undervalued. Hybrid securities can combine features of debt and equity, but they may add complexity, covenants, priority claims, or future dilution. Asset sales can help fund the transaction and sharpen strategic focus, but they may force the company to sell assets at unfavorable prices or reduce future operating flexibility. Financing is not separate from valuation. It changes risk, required returns, tax shields, ownership, liquidity, and flexibility. The best financing plan supports the acquisition without making the combined firm fragile. Before we close, let's connect acquisition valuation to accretion, dilution, and managerial decision-making. Accretion and dilution analysis estimates how the acquisition affects earnings per share. A deal is accretive when pro forma earnings per share increase. It is dilutive when pro forma earnings per share decrease. This analysis can be useful. It helps managers understand accounting effects, investor communication, analyst expectations, debt covenants, and compensation metrics tied to reported earnings. But accretion is not the same as value creation. A deal can increase earnings per share and still destroy value if the economic cost of capital, integration risk, premium paid, or opportunity cost is too high. A value-creating deal can also be dilutive in the near term if synergies take time or integration requires investment. So the decision rule must remain focused on cash flow, risk, and the full economic cost of the deal. A practical acquisition process begins with standalone value, then buyer-specific synergies, then integration and transaction costs, then the maximum value creating offer price. After that, managers evaluate seller expectations, auction dynamics, payment method, financing structure, leverage, dilution, liquidity, credit risk, and downside cases. The sequence matters. Structure can allocate risk, but it cannot rescue weak economics. Thank you for joining me today. I hope this lecture helped you understand how disciplined acquisition valuation protects shareholder value.